Most people never realize this quiet force is already shaping their retirement money. This stock market AI bubble is when the price of AI-related companies in the US stock market rises much faster than their real value can support. In simple terms, it's like everyone suddenly believing a toy is magical and worth more and more money every day, not because it actually changed, but because people are scared of missing out. In the real US stock market, this often happens when investors rush into companies connected to artificial intelligence like chip makers, software platforms, and tech giants, pushing their stock prices extremely high. The danger is not the AI technology itself, but the extreme excitement and hype around it, which can disconnect prices from real profits, real earnings, and real business strength. This is where money quietly starts becoming unstable. In the stock market, retirement accounts like 401ks and IRAs are heavily invested in large US companies. Many of these companies today are deeply tied to AI growth expectations. When investors believe AI will change everything, they buy stocks aggressively, making prices rise even if the company has not yet earned that future money. This creates a fragile situation where the market depends more on belief than actual results. If the companies later fail to meet high expectations or if growth slows down, the prices can suddenly drop fast. That drop is what people call a bubble burst, and it can directly reduce the value inside retirement accounts. Most people don't see how fast confidence can disappear. An AI bubble becomes dangerous when too many investors assume prices will always go up. In the US market, this can happen over months or years as more money flows into AI stocks through index funds, ETFs, and retirement plans. The risk builds quietly because it feels normal while prices are rising. But the real weakness is that stock prices may become tied to future promises instead of current performance. If big companies report slower profits, higher costs, or disappointing AI results, investors may panic and sell at the same time. That panic creates a chain reaction where prices fall faster than they rose. This is what makes retirement accounts vulnerable. Retirement accounts are not usually actively traded by individuals every day. They are often long-term investments. That means when a bubble grows, many people don't react quickly. They continue contributing money through automatic payroll deductions, unknowingly buying overvalued stocks at high prices. If a sharp correction happens, like a sudden market drop, the total value of those accounts can shrink significantly on paper. The real danger is timing. People close to retirement may not have enough time to recover losses because stock markets can take years to stabilize after a major bubble correction. This is the part almost nobody pays attention to until it happens. There is no specific exact date that can be predicted for when an AI bubble would wipe out retirement accounts, because markets don't follow a fixed schedule. It depends on investor behavior, company earnings, interest rates, and global economic conditions. What matters most is understanding how fragile expectations can become when hype grows too fast. The only practical protection is long-term diversification across many industries, not just AI-heavy stocks. So, a single sector does not control all retirement savings. When hype cools down and reality catches up, prices stabilize again. But during that adjustment period, retirement accounts can experience strong temporary losses before recovering over time. Don't miss what happens next. Tap the next video now before this truth gets buried again.